All right, okay, well, here we go. I mean, essentially, the markets have been right. Oh, come in. How many webinars have we done on FX Street now? I must have done hundreds and hundreds and hundreds. We do a simple sound check, and you tell me you can see the screens. Nothing's really changed. So why was there nothing said to me before? Come on, guys. Right. So here's the correlation here. So as I said, the dollar against Japanese yen could only really strengthen. I mean, when we go back to the monthly, we were always going to see this aggressive bounce at some point. We didn't really break these kilo levels, psychological levels below 100 with any kind of real aggression. Again, the bounce, the bounce, the bounce, and towards us knowing interest rates were going to go up. Again, the markets naturally did the opposite of what we thought. Sold off that dollar until we got to the low levels around that 100, that key psychological level. And then when we found out that rates were definitely going up after Trump, because that was uncertainty, but then the market almost priced it into 97%. We got that extra bonus of the Fed saying there might be 3 hikes instead of 2. And that sent the markets back up. Key levels that have been highlighted, 117. Yeah, we easily broke through that. Then 121, 124, and the next kind of key levels are where I've said it's going to get to in the past. And then you've got your fib expansions. 131 looks really realistic. Again, with an aging population like Japan, a lot of cultural problems, a lot of problems just in general. The government own a lot of the Nikkei, and just other kind of powers, from the technological side, are really kind of getting involved and pushing that technological drive forward in the global capacity. And Japan are not really. Oh, again, they're a major force still, but they just don't seem to be as reliable, it seems, as the alternatives. So people are pulling out of the currency and putting it in something where they know they're going to get a return. That's the dollar. So all you have to do, again, is look at the weekly strength that's come off the back of this, this rate announcement, and the charts kind of tell you a picture. The charts don't lie. We found, the market sold off on the anticipation that we're going to get a rate hike that everybody knows. Okay, so that can be central bank, can be big players selling it off into what we know. And then as we get that added bonus of 2 rate hikes instead of 3, then the market then bounces back up. So 117 was always a nice target to be hit. And again, we've seen plenty of green now. So I'd say maybe some consolidation into when Trump actually gets to be president, then maybe we see a little bit of a dip down, and then I can only see again support back on 117, targeting 121 and 124, and new highs above that. As I say, up to 131, 135. Certainly realistic, because you're not going to see interest rate hikes in the European Union anytime soon. Mario Draghi's talked finally about tapering quantitative easing and done it in a really roundabout way by keeping the tapering going, keeping the quantitative easing going for longer, but reducing the amount down. So it's kind of a roundabout way of doing things. Now, we know that inflation has jumped because of Brexit. So Mark Carney, his only job was to put interest rates up in the UK. That was his only job. So he's going to have to do that at some point to control inflation. And that, again, is going to mean global demand is going to come back in for the pound. So for me, I don't see this relationship where is the dollar spikes against other currencies and the euro and pound get equally as sold off. What I'm thinking, and what I'm kind of thinking, is that the euro is going to get to parity. We've never really recovered from this sell-off, have we, in 2014? Slowly, and we've gone on to make new lows here. All these key levels have been broken. So when you look at the kind of weekly chart, I mean, a little bit messy because the higher time frame charts are, but you can see everything that could have acted as support hasn't. It's all acted as resistance. So really, when the markets, we talked about, to UBS, Deutsche Bank, all the big players have said that parity, is on the cards, and that's down here. So, if you look at any monthly, weekly, daily, it doesn't look good, does it? All the kind of stop grabbers have been triggered. All the kind of wicks are to the high side. It just points lower. So I would say that realistically, once we get, new lows below 103,645, then that parity isn't a million miles away. And, again, how we've sold off in the last kind of week, it's only, a week, 10 days, 20 days, a month of selling. We can easily break, this move. So I would say the 19th of January is a big indication of what could be important for the euro, because that's the ECB meeting. And then the day after, we've got Trump. So Trump positive, ECB negative, not looking good for that euro. Okay, not looking good for that euro against the dollar at all. And the euro pound at lows. So it doesn't look good. But realistically, again, that kind of fundamental reasons are not that I want the pound to necessarily go up. I just think that there's more room to buy the pound than the euro. Sure, the same kind of picture, kind of sell off into Brexit. We've hit these lows, etc., etc. But you look at the weekly charts, it's not looking great. I still think we've got the possibility of making new lows below 120, and maybe we get as low as 115. But I think once we get, if we do get to 115, that's really as low as we go. I don't see the pound getting to parity against the dollar. And I think when you think about the world the way it is, who's going to put their faith in the EU over the UK? I mean, we still have this strong relationship with the US. We still have a lot of things in our favour, as in we're a small island and pretty rich. So I would say that if the euro does get to parity, it runs the risk of having, its status as world global reserves, not revoked, but kind of revisited. And then if you're, a major country, major player, where are you going to put your cash? It's not in the renminbi, is it? It's not in the yuan. It's not in the, the yen. It's not in the Aussie dollar. It's not in the New Zealand dollar. It's not in the Swiss franc anymore. Maybe a little bit in the Norwegian kroner. But again, when there's this much money floating around, you can't have too much money in a small country. You have to diversify. So the European Union and the euro will still be there, but if there's any real worries that it's going to get smashed below parity and stay low, then maybe people look for the pound. So I think around 115, the market would seriously start to buy up. But what realistically I see, I think 123 is the low point. I'm going to go out on a limb here, and that we start to really, kind of slowly but surely get back to, to nice levels above 130, 132 I think are good, 158 and 164. I could see within 18 months to 2 years we're back at 164 in the pound. And I really do believe that, because I think that you think the way the UK works and the politicians, they're out there already. They're doing their little kind of pre-chats. I know we can't make any decisions or any kind of trade deals until Article 50 is triggered. But politicians are politicians. They're out there. They're out there trying to save their jobs. They're out there trying to save the country, doing what they do. So there's no shortage of people that want to do a trade deal with the UK, no matter what you read in the papers. Australia, yeah, they're all over it. China, don't trust me. They're all over it. They're looking for anywhere to put their money. The US, Donald Trump said we're to the front of the line now because of our special relationship. He's pals with, Nigel Farage. How that's going to end, who knows? Who really cares? But as long as we've got one foot in the door, it makes no difference. So all of a sudden, we could be talking 3-4 major countries we're doing trade deals with, and then we're saying to Europe, you know what, Europe? Back. Yeah? Get back on the back foot now. We'll deal with you when we want to deal with you. And all this freedom of movement, it's Europe that's going to lose. It's as simple as that. I mean, obviously there's going to be some ramifications for UK people, but we've got the problem with immigration. That's what people voted for Brexit. The problem with too many low-skilled workers coming to the country, and we don't like that. We don't like it, the strain on the NHS. We don't like paying for benefits. We don't like the change in, cultural attitudes. Yada, 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 whatever it is. We voted, so the government has to see it through. So the economic side will obviously be very important, but we can't keep talking about everything in monetary terms. It has to be the social side, people's happiness as well. So I think once that balance starts to be hit and struck, with the economic and social side, then we're going to see that, the UK is going to become an attractive place once again. I think it's all about taking power back. The EU was a social experiment that didn't really work for me, to be honest. It didn't really work. I mean, it did. All the money for infrastructure was spent. A lot of people got very rich. A lot of people's property went up, and everybody was happy. And now it's not working. So if it's not working, you have to change it, move with the time. So for me, I still think there are definite dangers of a short-term kind of like blip down in the pound, but it's going to be short-lived. I'll be buying any dips below 123, 120. And if we got to 115, then I don't know. You'd have to maybe think about your overall strategy. But I'm not a long-term trader, so I would only be buying dips in the short term in the pound. So going into the end of the year, I think 124 is not bad. It could have been substantially worse, couldn't it, in the pound? And I think 1042 in the euro again. It is not terrible, but it's not great. I think the euro is in a lot worse shape in the kind of medium short term than the pound is. So again, only going to see dollar strength after Trump's in, after we figure out if he's going to be received well by the markets. And remember, the markets are trading so politically now that it's very difficult to know how the market is going to position itself, because at the end of the day, we've got all the economic data that they have, but at the end of the day, we can keep seeing good or bad economic data. Doesn't mean it's going to translate into the movement we want. So I still think a lot of it all revolves around interest rates, finally getting to that 1%, being in the US and seeing the ramifications on people's ability to pay down debt and to still kind of live. And then once that has been kind of assessed, maybe end of Q1, maybe, the end of Q2, then we start to see what Trump is doing, all the effects he has on policy, and that's going to lead through to either continued dollar strength or continued stock market strength, or, as I suspect, the dollar's going to kind of really kind of, be very volatile, be up and down, and just be more of an up-down range, have no real direction, and then it'll be the stock markets that get punished because the stock markets are so overbought, and that's really what's going to happen when, good or bad, when interest rates get above 1%, stock markets are in trouble, because there's nowhere else for the kind of cash to go. I think everybody who's institutional style investor and long-term investor, they're not going to put the money in gold. They're going to put the money in gold. Gold have rocketed by now, as I've said to you a million times. Gold looks tremendously weak. We're bouncing off some low trend lines here, but essentially below 120. There's nothing keeping gold, until it gets to $1,000. I've said this a million times. There's nothing on that chart technically, and there's nothing, in my mind fundamentally that's going to make gold get back to 15, 16, 17, 18, 1900. I mean, what is it? Any bad news we've had in the world, we've had it. We've had unexpected Trump, unexpected Brexit, unexpected VW scandal, unexpected, migrant crisis. If any of these things were going to have an overriding factor, then here, gold would have got to 14, 15, 16. It would have done, and it hasn't. It rejected. It bounced up. It rejected. And now it's just hitting trend lines for fun. We break this trend line here. We've got all the previous levels to go at. Yeah, nice lows at 107.7. Nice lows at 145. Nice lows at 130. 130, we don't bounce this time. Well, we don't bounce this time for sure, below this. So we break 130 and we get to $1,000. I mean, I don't see any scenario where gold doesn't test $1,000. There's nothing coming fundamentally, unless Trump comes out and says, yeah, I'm going to wage war in Iran, I'm going to stop the nuclear program, I'm going to cut ties with China, then yeah, gold goes to, whatever, $2,000. But we're all dead. There's no point in buying anything because the world will have ended. So I can't see any realistic idea of what's going to happen unless it's some sort of disastrous World War III or some massive gaffe that he does where, King Jalil say he's going to come and shoot the world. I don't know, whatever. I don't see any scenario where gold goes up that doesn't equal the end of the world. So it doesn't matter then, does it? So I see that really these lower trend lines are going to continue to be tested. Maybe we'll just consolidate in Q1 and the run up to Trump, getting in. But, if the dollar continues to go up, gold goes down. If the stock markets go up, gold goes down. If stock markets go down, I still think gold goes down, because I don't see this natural correlation that we've seen in the markets before where, stock markets and gold are inversely correlated. Everything right now isn't as it seems, because again, the world isn't trading off normal economic data and conditions. It's still trading this political mindset. So it's really, 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 really difficult to trade things on their own, but also very difficult to trade things with positive and negative correlations and the kind of coefficients in the currencies that really did work, years and years and years ago. So, as I say, there will be movements before Trump, but I don't think anything's going to happen now. I think pretty much as we're on the 19th, we've got 3 days after this of real trading. I don't really see we've seen much great trading opportunities unless you're very directional style trading. I know a lot of people have been caught long the stocks. I know a lot of people have done some silly trades and lost lots of money, towards the end of the year, which is never good. Markets are thin coming up to Christmas, and they're very, very, very easy to manipulate and to be volatile. So you can be right plenty of time in high volume and get out, or wrong plenty of time in volume and get out for a reasonable loss. But in thin volume, you really are in trouble if you're wrong. So I would say, again, really what it is about positioning yourself in the markets next year short term. So have an idea that when the next rate hike will be, and then look for a top in stocks and sell some big spikes up, because more likely people are going to get out of risky investments and put into cash as we get above that 1%. Take the kind of Trump factor with a pinch of salt. He's tweeted this, he's tweeted that. Markets have moved, but they're still fairly steady. So, again, I'd be very wary of trading things on the back of Donald Trump's, what he says, and certainly what he tweets. Then after that, really, essentially, I don't see any reason I've said for gold to continue to spike up. We might get back high as 156, 160, but there's a big trend line here that I'm waiting for around about 121. And once that goes and acts as resistance, then gold, for me, can only, get down and break that $1,000 psychological and technical level. So realistically, 2017, you're looking for stocks to start topping out, and that's in relation to interest rates. Don't look at much else outside of that. Just people pulling out because they get a better return from cash than they do from a traditionally risky investment. And when it starts to sell, if you don't see the dips being bought back up, then we're going to see a major, major correction. Gold, let it spike up, sell the highs. Euro, let it spike up, sell the highs. Pound, let it spike down, buy the lows. Dollar, let it spike down, buy the lows. And that's your intraday trading strategy for 2017. Wait for the interest rates to get above 1%. Wait to see what Donald Trump does. And position yourself short term. 15-minute, hourly candles, waiting for spikes, selling into strength and weakness where you see it in that roundabout way of how I've described the markets. Other things to maybe look at, some of the more exotic currencies, pound against the New Zealand dollar, things like that. Again, it's trying to figure out, countries like New Zealand that still have an interest rate. If the UK is going to put theirs up and, New Zealand might have to cut them down, then, these big sell-offs that we've seen, in Brexit, might be pulled back. So, think about, the pound was 122, then we had Brexit and we got smashed back down. But, is the UK going to remain stronger economy-wise than New Zealand? Yeah, of course it is. So we get back above 180, then we've got 190, 193, 199, 2. Yeah, the market's been high as, 2.5. So Brexit, it was the reason for the sell-off in that, nothing else. So that fundamental information's absorbed now. But the reality is, New Zealand's 4.6 million people, the same size as the UK, land mass, okay? Okay, London is twice that size. And think about the money it generates. So you can only see, really, the markets bounce and the New Zealand dollar getting weaker as it has the ability to cut its rates, and the UK has the ability now to put up rates. Yeah, so we see that kind of these low points being broken. So 190, I think parity. 2 looks kind of pretty likely to me in the next kind of 3, 6, 12 months. So again, look through your currencies. If you think the pound has bottomed out, as which I think, long term, then look for opportunities, to get involved in different currencies. And that's it, really. If the US dollar does well, then it's not going to continue to punish the pound and the euro equally. I think euro is going to really take the brunt of it, and then the pound is going to kind of come back up because that has the ability to put rates up, whereas the eurozone don't. So again, for me, all this is kind of very subjective, long-term, medium, all that kind of stuff, and you've got to figure out what type of trader you are. But for me, really, it's just looking for any kind of big sell-offs in the pound against any currency. I'll buy them, and I'm talking 15-minute, hour, 2-hour trades. Anything that's kind of really a longer-term view like gold. Again, I'm not going to buy it because I don't see any value. selling it. So if it does get to levels, like 1156.9 quickly, I'll sell it. I'm not holding it for these breaks. I'm just looking to sell, spikes. And when they spike up, look, 5 minutes, you get a decent 10-minute sell-off. On the size I trade, I'm not looking to make, more than 15, 20 pips. So that 22 pips, bang, that's, we're trading £500 a point. I'll take that. Spike up here, gets down to this 1137. I'm out. I'm not looking for that long-term direction. I'm looking to make money off the movement. All right, guys, any final thoughts, any final questions? I guess the overview, is always the way I kind of leave it. Essentially, again, stock markets remain strong, so sell them at your peril. And I mean sell and hold, because they have the ability to spike up. The pound, I think, longer term, medium term, is going to bounce back, but it has the ability to break 123, 120 short term. Euro, I think, is much weaker than the pound. The dollar's going to remain strong because of the interest rate hikes, but we have that unknown quantity of Donald Trump on the 20th. FTSE never really been comfortable at 7,000, so I wouldn't really advise aggressively buying short, medium, or long term over that. And that's really it. Really, gold is my watch for next year. I don't see any reason why, technically, fundamentally, gold will get bought up. And that's it. That's how I'm leaving it, guys. That's what I think for 2017, and what's happened in the past will help us to predict the future. But I think all the major things, all the major signs now, with interest rates going up in the real world, that we're going to get rid of this free credit, this idea that people can live their lives on credit, and we're going to get a more realistic view over the next 5, 10, 15 years. And again, it's only millennials who are going to get punished for it, as always. The baby boomers are still going to do fine because they've made their cash. When interest rates go up, they sell the house and put the cash into cash, and happy days, really. All right, guys, anything final? No, sorry about you not being able to see the charts at the beginning. That was just a bit of a technical oversight on our point. To get hold of me, Steve Ruffley on Twitter, or sruffley@tradermaker.com. Get me through my FX Street page. But that's it, really. It's going to be an interesting start to the year, that's for sure. So save your bullets. Don't go wasting your bullets on thin markets pre-Christmas. Go and do some Christmas shopping. Go and do some charting. Go and get some ideas, write a plan. But these markets are particularly dangerous, so don't start smashing into them now. All right, guys. Pleasure as always, and I will see you all next year. Okay, thanks. Take it easy.